Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate mumbo jumbo. Today we're diving into a report that's about as exciting as watching paint dry. But trust me, there's some interesting stuff hidden beneath the surface. We'll try to decode what is real and what is PR. This time we're looking at a filing from the Federal Home Loan Bank of Dallas, or FHLB Dallas. Basically, this report tells us about some new debt that FHLB Dallas has taken on. Think of it like a credit card statement, but for a giant bank. They're letting everyone know how much they've borrowed and what the terms are. FHLB Dallas got into some new debt in February. This debt is backed by all the Federal Home Loan banks together. That's 11 banks in total sharing the risk. The debt isn't backed or guaranteed by the United States government. It's secured by all the banks. FHLB Dallas gets most of its money by selling debt securities, which are called consolidated obligations. It's a fancy name for bonds and discount notes. These consolidated obligations are basically IOUs that the bank sells to investors to raise funds. It is worth noting that these obligations are backed by all the FHL banks. The debt is sold to the public through the Office of Finance, which is a joint office of the FHL banks. They work with authorized securities dealers to make these sales happen. Here's a key point to remember. These consolidated obligations aren't backed by the US government. They're only supported by the financial strength of the FHL banks. So if you're an investor, you're betting on these banks to be able to pay back the money they borrow. Schedule A is the most important part of the report. It lists all the bonds that FHLB Dallas has committed to issue. In other words, it shows all the new debt they're taking on. If FHLB Dallas took over responsibility for paying back debt from another FHLB, that's also included here. Those situations are flagged with a special symbol. The schedule doesn't include discount notes, which are short-term debts that last a year or less. Also, it doesn't show debt issued by other FHL banks where FHLB Dallas isn't the main payer. Now, there are a few things to keep in mind when looking at this information. FHLB Dallas isn't saying whether these bonds are a big deal or not, or something normal. The report doesn't include any information about interest rate swaps or other financial tools that FHLB Dallas might use to manage its debt. It also doesn't tell you how the bank will use the money it raises from selling these bonds. Will they use it to pay off old debts or something else entirely? To get the full picture of FHLB Dallas's debt, you need to look at their regular financial reports. The numbers in Schedule A show the main amount of the bonds. However, these numbers might not match what you see in FHLB Dallas's financial statements. That's because the financial statements take into account discounts, premiums, and hedging adjustments. Think of it like buying a car. The listed sticker price may not reflect all the taxes and fees. The footnotes at the end of Schedule A explain the different types of bonds that FHLB Dallas is likely to issue. However, they don't cover every type of bond that other FHLBs might issue. Now, let's dive into Schedule A itself. We will go over the main points. The first bond was committed to be issued on February 12th and has the CUSIP number 3130B54Q8. A CUP is like a serial number for financial securities. The bond was settled on February 19th, maturing or coming due in February of 2055. That's a long way off. The next payment is due in August. The bank can call this bond, meaning it can pay it off early if it wants to. The call type is optional principal redemption, and the style is Bermudan. That means they can call it on certain dates. The rate type is fixed with an initial coupon rate of 6.250%. Basically, a coupon rate is the interest rate that a bond pays to its holders. The par amount or face value of the bond is $25 million. The next bond has CUSIP 3130B54S4, maturing in February of 2030. The coupon rate is 5.125%. Same call type and style as the previous bond, and the par amount is also $25 million. The third bond with CUSIP 3130B54U9 matures in June. It is non-callable, meaning the bank cannot pay it off early. The rate type is variable, meaning it changes. The rate type is described as single index floater. In this case, the rate is overnight SOFR minus 1.50 basis points. A basis point is 1/100%. The par amount for this bond is much larger at $1 billion. The fourth bond has QSIP 3130B54X3 maturing in May. It is callable with a Bermudan call style. The coupon rate is 4.455% and the par amount is $250 million. The next bond matures in February of 2027 with a coupon rate of 4.625% and a par amount of $25 million. It has optional principal redemption and the style is Bermudan. The next bond matures way off in February of 2045 with a coupon rate of 6.050% and a par amount of $25 million. It has optional principal redemption and the style is Bermudan. Next up is a bond maturing in February of 2028 with a coupon rate of 4.750% and a par amount of $25 million. It has optional principal redemption and the style is Bermudan. The 8th bond matures in February of 2055 with a coupon rate of 6.270% and a par amount of $20 million. It has optional principal redemption and the style is Bermudan. Let's switch dates now. On February 13th, more bonds were issued. We see the first one is the same CUSIP as an earlier one. These are called bond tranches. The same bond is offered on different dates. We see the same CUSIP with another 6.250% coupon rate, bond maturing in 2055. The next bond matures in March of 2026 with a coupon rate of 4.408% and a par amount of $125 million. It has optional principal redemption and the style is Bermudan. The next bond matures in August of 2025. It is non-callable and is a variable rate bond. In this case, the rate is overnight SO of minus 0.50 basis points. The par amount is $250 million. The next bond matures in March of 2026 with a coupon rate of 4.400% and a par amount of $250 million. It has optional principal redemption and the style is Bermudan. The next bond matures in March of 2026 with a coupon rate of 4.400% and a par amount of $577 million. It has optional principal redemption and the style is Bermudan. The next bond matures in March of 2026 with a coupon rate of 4.400% and a par amount of $600 million. It has optional principal redemption and the style is Bermudan. Now we switch dates to February 14th. Once again, we have the same bond being issued as a tranche from before. We see the same CUSIP with another 6.250% coupon rate bond maturing in 2055. The next bond matures in September of 2025. It is non-callable and is a variable rate bond. In this case, the rate is overnight, so of the par amount is $500 million. So that's Schedule A in a nutshell. It shows the different bonds that FHLB Dallas is issuing, their maturity dates, interest rates, and other key details. The call type description: the optional principal redemption means the bonds can be redeemed early, according to the bank. Scheduled amortizing bonds repay principal based upon a predetermined schedule. American means the bond is redeemable continuously until maturity. Bermudan means it is redeemable on specified recurring dates until maturity. Conversion bonds can change the coupons from fixed to variable rates on a predetermined date. Fixed bonds pay interest at a constant rate. Variable bonds pay interest that resets based on an index. Constant bonds pay interest at constant fixed rates over the life of the bond. Step-down bonds pay at decreasing rates for specified intervals over the life of the bond. So what does all this mean? Well, it tells us that FHLB Dallas is actively borrowing money in the market. They're issuing a mix of short-term and long-term debt with both fixed and variable interest rates. The fact that they're issuing callable bonds gives them some flexibility to manage their debt in the future. Now, let's step back and look at the bigger picture. FHLB Dallas is one of 11 federal home loan banks. These banks play a critical role in the US housing market. They provide funding to local lenders, which in turn helps people buy homes. By borrowing money in the market, FHLB Dallas is able to support these lending activities. However, it's important to remember that these banks are not backed by the US government. They rely on their own financial strength to repay their debts. This means that investors need to carefully assess the risks before investing in their bonds. So, is FHLB Dallas in good shape? It's hard to say for sure based on this single report. We need to look at their overall financial performance, their asset quality, and their risk management practices. However, the fact that they're able to issue debt at reasonable interest rates suggests that investors have confidence in their ability to repay. One thing that stands out is the amount of variable rate debt they're issuing. This could be a risky strategy if interest rates rise, as their borrowing costs would increase. On the other hand, if interest rates stay low or fall, they could benefit from lower borrowing costs. Overall, it's a mixed bag. FHLB Dallas plays an important role in the housing market, but they also face risks. Investors need to do their homework before investing in their bonds. I personally think the FHLB Dallas bonds represent a stable investment, but can be affected by volatility in the market. As such, I recommend a neutral to slightly bullish outlook with a possible volatility of 5% in either direction. Thanks for watching Corporate Decoder. Stay tuned. Please consider subscribing and sharing this video so more people understand how the corporate world works.